On October 16, 2001, Enron was worth $63 billion. 24 days later, it was worthless. This is the story of how America's seventh-largest company pulled off the greatest corporate fraud in history, fooling everyone from Wall Street analysts to their own employees, until one phone call brought their entire empire crashing down. Kenneth Lay founded Enron in 1985 with a simple vision: become America's largest natural gas company. By 1990, they controlled 15% of the U.S. gas market. But Lay wasn't satisfied. He hired Jeffrey Skilling, a brilliant McKinsey consultant who had a radical idea: forget about owning assets. Instead, they'd become energy traders, buying and selling contracts for future energy deliveries. This single decision would transform Enron into a $100 billion giant, and ultimately destroy it. Skilling introduced mark-to-market accounting in 1992. Instead of recording profits when actually earned, Enron could book the entire projected value of 20-year contracts immediately. Sign a $100 million energy deal. Book all $100 million as profit today. Wall Street loved it. Enron's stock soared 311% in 5 years. Employees became millionaires overnight. Fortune magazine named it America's most innovative company 6 consecutive years. But behind the celebration, something sinister was brewing. Andrew Fastow, Enron's CFO, created something unprecedented: a web of 3,000 special-purpose entities, essentially fake companies designed to hide debt. These partnerships had names like Jedi, Chuco, and LJM. Enron would sell its worst assets to these entities, making its balance sheet look clean. The entities borrowed money to buy the assets, but Enron secretly guaranteed the loans. When deals went bad, losses vanished into this shadow network while Enron's books showed pure profit. By 2000, Enron was America's seventh-largest company with $101 billion in revenue. CEO Jeff Skilling rang the opening bell at the New York Stock Exchange. Employees' retirement funds were locked in Enron stock, now worth $90 per share. The company's 50-story Houston headquarters became a symbol of American capitalism. But that same year, Enron lost $644 million, losses completely hidden from investors through Fastow's partnership maze. The house of cards was already collapsing. Sharon Watkins, an Enron accountant, noticed something wrong in August 2001. Digging deeper into company finances, she discovered the partnerships were essentially hollow shells. On August 15, she sent an anonymous memo to Kenneth Lay: "I am incredibly nervous that we will implode in a wave of accounting scandals." She warned that Enron might be nothing more than an elaborate accounting trick. Lay dismissed her concerns. 3 months later, her words would prove prophetic. Jeff Skilling abruptly resigned as CEO on August 14, 2001, citing personal reasons. Wall Street was stunned. The architect of Enron's transformation was abandoning ship at the company's supposed peak. Kenneth Lay returned as CEO, but confidence was shaking. Then came the earnings call that changed everything. When analyst Richard Grubman asked simple questions about Enron's balance sheet, Skilling snapped: "You're an asshole." The outburst went viral across Wall Street trading floors. On October 16, 2001, Enron announced a $618 million quarterly loss and a $1.2 billion reduction in shareholder equity. The markets panicked. Enron's stock plummeted 20% in one day. Rating agencies threatened downgrades. But the real bombshell came next. The Securities and Exchange Commission launched an investigation into those mysterious partnerships. Suddenly, Andrew Fastow's financial engineering was under federal scrutiny. Investors began asking the question that would destroy Enron: what were they hiding? The walls closed in rapidly. Dynegy, a smaller energy company, offered to acquire Enron for $10 billion, a 80% discount from its peak value. But due diligence revealed the true horror: Enron had $38 billion in off-balance sheet debt. The partnerships weren't just hiding bad deals, they were concealing obligations that could bankrupt any company. On November 8, Dynegy walked away. Enron stock fell to $7. 21,000 employees watched their life savings evaporate. November 28, 2001, Enron's credit rating was slashed to junk status. December 2, Enron filed for Chapter 11 bankruptcy, the largest in U.S. history at that time. The company that controlled 25% of America's energy trading disappeared overnight. Arthur Andersen, Enron's accounting firm and one of the Big Five auditors, was caught shredding documents. They would soon collapse too, taking 85,000 jobs worldwide. The fraud had claimed two corporate giants. The human cost was staggering. Enron employees lost $1.3 billion in retirement savings. Many had borrowed against their company stock to buy homes, now facing foreclosure. Thousands of retirees saw their pensions vanish. Meanwhile, executives had cashed out $924 million in stock before the collapse. Jeff Skilling alone sold $200 million in shares while telling employees to keep buying. The contrast between executive wealth and worker devastation sparked national outrage. The trials began in 2004. Kenneth Lay, guilty on 10 counts of fraud and conspiracy. He died of a heart attack before sentencing. Jeffrey Skilling, sentenced to 24 years in federal prison. Andrew Fastow, pleaded guilty and received 6 years. But their punishment couldn't restore the $74 billion in shareholder value that vanished, or the lives destroyed. The Enron scandal forever changed how America views corporate America, proving that even the mightiest companies can crumble when built on lies. Enron's collapse triggered the Sarbanes-Oxley Act of 2002, the most sweeping corporate reform since the 1930s. CEOs must now personally certify their financial statements under penalty of prison. Accounting firms can't audit and consult for the same clients. The Public Company Accounting Oversight Board was created to police auditors. These reforms came too late for Enron's victims, but they've prevented countless future frauds. From Enron's ashes rose a new era of corporate accountability, bought with the life savings of 21,000 workers. In just 24 days, Enron proved that no company, no matter how large, how innovative, or how praised, is immune from the consequences of fraud. The energy giant that once powered America became a cautionary tale that still echoes through corporate boardrooms today. Sometimes the brightest stars burn out the fastest.